Importance of the close of the bar. A 5-minute bar usually assumes something similar to its final appearance seconds to a minute or more before the bar closes. If you enter before the bar closes, you might occasionally make a tick or so more on your trade. However, once or twice every day, the signal that you thought was going to happen does not, and you will lose about 8 ticks. That means that you need about 8 early entries to work as planned for every one that does not, and that simply won't happen. You can enter early with trend in a strong trend and you will likely be fine. However, when there is a strong trend, you have so much confidence in the signal that there is no downside to waiting for the bar to close and then entering on a stop beyond the bar. You cannot be deciding on every bar if an early entry is appropriate, because you have too many other important decisions to make. If you add that to your list of things to think about, you will likely end up missing many good trades every day and forego far more in missed opportunities than you could gain on an occasional successful early entry. This holds true for all time frames. For example, look at a daily chart and you will see many bars that opened near the low but closed in the middle. Each one of those bars was a strong bull trend bar with a last price on the high at some point during the day. If you bought under the assumption that the bar was going to close on its high and bought near the high and instead it closed in the middle, you would realize your mistake. You are carrying home a trade that you never would have entered at the end of the day. There are 2 common problems that regularly occur on the 5-minute chart. The most costly is when you try to pick a bottom in a strong trend. Typically you will see a lower low after a trend line break and traders will be hoping for a strong 169. 170. Price action. Reversal bar, especially if there is also a bear trend channel line overshoot. The bar sets up nicely and is a strong bull reversal bar by the 3rd minute or so. The price is hanging near the high of the bar for a couple of minutes, attracting more and more counter-trend traders who want to get in early so that their risk will be smaller, their stop will be below the bar, but then with 1 to 5 seconds remaining before the bar closes, the price collapses and the bar closes on its low. All of those early longs who were trying to risk a tick or 2 less end up losing 2 points or more. These longs let themselves get trapped into a bad trade. A similar situation happens many times a day when a potential signal bar is forming just before the bar closes. For example, a trader might be looking to short below a bear reversal bar that has seconds to go before it closes, and the current price is on the bottom of the bar. With less than a second before the bar closes, the close bounces up 2 or 3 ticks from the low of the bar, and the bar closes off its low. The market is telling the trader that the signal is now weaker, and the trader needs to avoid getting trapped into trading based on the expectation and hope that she had just 3 seconds ago. The other common problem is getting trapped out of a good trade. For example, if you just bought and your trade has had 3 to 5 ticks of open profit but the market just can't hit 6, allowing you to scalp out with 4 ticks of profit, you start to become nervous. You look at the 3 or 5 minute chart with about 10 seconds before its bar closes and it is a strong bear reversal bar. You then move your protective stop up to 1 tick below that bar, and just before the bar closes, the market drops and hits your stop, only to pop up several ticks in the final 2 seconds of the bar. Then, within the first 30 seconds of the next bar, the market quickly goes up to 6 ticks where smart traders took partial profits while you are sitting on the sidelines. Good entry, good plan, bad discipline. You just let yourself get trapped out of a good trade. If you had followed your plan and relied on your initial stop until the entry bar closed, you would have secured your profit. There is one other point about bar closes. Pay very close attention to the close of every bar, especially for the entry bar and the bar or 2 later. If the entry bar is 6 ticks tall, you would much prefer seeing the body suddenly increase from a body that was 2 ticks to one that was 4 ticks in the final seconds of the bar. You will then likely reduce the number of contracts that you will scalp out. This is true for the next couple of bars as well. If there are strong closes, you should be more willing to swing more contracts and hold them for more points than if these bars had weak closes. Another reason why the close is important is that many institutional traders place orders based on value and not price action, and when they look at charts, the charts are line charts, which are based on the close. They would not look at charts at all if the charts did not influence the decision making, and the only price they are considering is the close, which increases its importance. Figure 8.1. The important smaller timeframe charts allow for smaller stops behavior greater of stopping a trader out of a good trade. In Figure 8.1, the insert on the left shows that traders using the 3-minute chart were stopped out, but traders who relied on the 5-minute chart did not get stopped out. The 5-minute E-mini had been in a strong bear trend for weeks and was now starting to have bigger pullbacks. Each new lower low was being bought, and the longs were profitable counter-trend trades. The bulls were more confident and the bears were becoming more willing to take profits. The thumbnail on the left is a 3-minute chart and the one on the right is a close-up of the 5-minute chart. Bar 11 was a strong bull reversal bar and a 2-bar reversal, and it was the second attempt to reverse up from a lower low. The E after bar 10 was the first, and it was the third push down on the day, a possible wedge bottom. This was a high probability long, but the stop would have had to be beneath its low, 3 points below the entry price. This was more than what was typically required in the E-mini. 2 points worked recently and when the average daily range had been about 10 to 15 points, but that was what the price action showed was needed. If 172. Price action. Figure 8.1. Traders were nervous. They could have just traded half size, but they must take a strong setup like this one and plan on swinging half. This is a perfect example of a common problem that traders face when they try to reduce risk by watching a smaller time frame chart. The risk is smaller, but the probability of success also drops. Since there are more trades on a 3-minute chart, there is more risk of missing the best ones, and this can lead to the overall profitability of 3-minute trades being less for many traders. Just like on the 5-minute chart, the 3-minute chart also had a reversal bar at bar 11. However, the stop below the entry bar was hit by a bear trend bar with a shaved top and bottom, indicating strong sellers. At this point, it would have been very difficult to reconcile that with the 5-minute chart where the stop had not been hit. The large size of the stop required on the 5-minute chart would make traders more willing to exit early and take a loss. If traders were also watching the 3-minute chart, they almost certainly would have exited with a loss and would have been trapped out of the market by that strong bear trend bar. The next bar on the 3-minute chart was a very strong outside bull trend bar, indicating that the bulls were violently asserting themselves in creating a higher low, but most of the weak hands who stopped out would likely be so scared that they would not take the entry and instead wait for a pullback. Stop runs on the 3-minute chart are much more common than on the 5-minute chart at important reversals, and smart traders look at them as great opportunities. This is because they trap weak longs out of the market, forcing them to chase the market up. It is always better to just watch and trade off one chart because sometimes things happen too quickly for traders to think fast enough to place their orders if they are watching 2 charts and trying to reconcile the inconsistencies. Deeper discussion of this chart. Bar 5 broke above a trend line in Figure 8.1, and bar 8 exceeded another by a fraction of a tick. Both breakouts failed, setting up with trend shorts. CHA